Stocks are a hold. They're not a buy right here. GDX is a buy. SLV, that's silver, is a buy. China FXI is a buy.
Hello everyone, I'm Giorgio Tavazza and you're listening to Avanguardia Investment Media. Today we are joined by Michael Belkin to talk about markets. Michael, thanks for being here.
Oh, thank you for having me.
So, Michael, why don't you start by giving some background about yourself and how you developed your forecasting model?
Okay, just so people have some idea about me, who I am, where I came from. I came out of the UC Berkeley, University of California at Berkeley Business School and Statistics Department. My study was forecasting. That's what I really concentrated on. I studied time series analysis, which nobody was looking at. I wasn't very happy with the things I learned in econometrics. They weren't very powerful forecasting tools, regression models, et cetera. They just didn't really do very much. They weren't very powerful. So I zeroed in on time series analysis, which is Fourier and Box-Jenkins ARIMA, that's autoregressive integrated moving average models. And I developed some preliminary results. I was sponsored by the head of the finance department, Marc Rubenstein, and that got me into Wall Street. So I was flown back by Larry Fink's team back then. He was at First Boston. They really liked me. And I arranged another interview with Salomon Brothers and with Laszlo Barini when they flew me back. And I was pretty much hired on the spot at Salomon Brothers. So I was at Salomon Brothers for about 5 or 6 years, started out in market analysis, ended up in proprietary trading. I was the quantitative strategist in proprietary trading on the equity side in the Liar's Poker years. When Meriwether and those guys were doing on the bond side, we were trading global markets on the equity side. Now, long story short, I developed a model that gives 3 things: direction, position, and intensity. So direction, up, down, or neutral; position, beginning, middle, or end; and intensity or confidence interval. So that's what I do: direction, position, intensity. It doesn't give you a predictive value of anything. It's not like it doesn't say the Dow Jones is going to 50,317. It doesn't give a level. It just gives direction, position, and intensity. That's in a 12-period forecast. So I'm using weekly and monthly data. A 12-period forecast using weekly data is 3 months, 12 weeks, 3 months. 12-period forecast using monthly data is 1 year, 12 months, 1 year. So 3-month forecast horizon for the intermediate term, 1 year horizon for the long term. That's what I focus on. And I'm looking for the strongest signals. Remember, direction, position, intensity. Intensity, the third thing. So intensity is the confidence interval or the strength of the signal. And those are different at different times, right? So this is the beginning of the year, still pretty close to the beginning of the year. And my strongest long-term signals using monthly data for this year are China up, Chinese equities; gold and gold stocks, GDX up; silver up; and bonds up, Treasury TLT T-bonds. And then that was it from the beginning of the year. So that's a 12-month view. It's not like you want to day trade off of that, but a theme a long-term investor can succeed with this year would be, I think, long Treasury bonds, long China, that's FXI ETF, long GDX, that's gold stocks, GDX, and silver, SLV, physical silver and gold, SLV and GLD ETFs. Now, since the beginning of the year, something else is set up, which is Bitcoin. Now, I've been short Bitcoin in fits and spurts on the way down, the model, and then it's kind of been basing for a while. And all of a sudden, I got an intermediate term buy signal 2 weeks ago on Bitcoin around the 17,000 level. Now it's around 21,000, just below there. So I think Bitcoin has bottomed for a trade. I really like Bitcoin and Bitcoin plays, which are not very many in the equity market. So there's the Grayscale Bitcoin Trust, GBTC, which trades at a big discount, by the way, and it's caught up in the digital, meltdown. Its parent company is having problems, Genesis. It's some of its subsidiaries not related to GBTC are potentially going into bankruptcy. The GBTC seems to be insulated from that. So that's one way to do it, and it trades at a discount. And then there's a bunch of Bitcoin stocks. I'm not going to put them out here, but they're basically Bitcoin miners, and value investors would certainly turn their nose up at these. They probably, they'd probably rather short them. But one thing I've learned over the years is to buy low and sell high. That's what my model does. So I'm looking for inflection points. So if you're not familiar with Fourier analysis, it looks for cyclicality in things. And my model is the same. It's based on the mathematics. I studied the mathematics behind Fourier and Box-Jenkins models, and then I developed my own approach. So it's an innovative way of forecasting using mathematics similar to Fourier. It's not exactly Fourier, but that's what I studied in the stat department at Berkeley, along with physics majors and engineering majors. Nobody else in the business school was doing that at the time. Okay, so anyways, buy low and sell high. Sounds simple. And that's what the model tries to do. So it's looking for these inflection points, and it spots one in Bitcoin. So, and believe me, I'm not a Bitcoin bubble person. I was not long Bitcoin all the way down. I'm looking for opportunities for trades, for things that are profitable, that my clients are, billionaire family offices, hedge funds, big asset management companies, some big bond houses around the world, everywhere from Hong Kong to Italy to London to New York, all over the world, Middle East. Anyways, so Bitcoin for a trade, I really like. And I think most institutional investors kind of turn up their nose and say, Bitcoin, who cares? I can't trade it. I get that. It's not an S&P sector or something that you can invest in. However, I think investors should remember what Sir John Templeton, who was one of the greatest investors of all time, said. He said, buy at the point of maximum pessimism and sell at the point of maximum optimism. And that's what I really try to use that philosophy. And that's what the model tends to operate on, that principle, even though it's not based on Sir John Templeton. But buy something when it's out of favor. Bitcoin's certainly out of favor, after SBF and FTC goes bankrupt and all these things. I think that was a kind of a climax catastrophic event in the cryptocurrency, for at least for a significant trade. So I like Bitcoin. I think it could have a significant, it's already up, 20% or something from where I had the original buy signal, but I think we could have a significant, at least 3 to 6 month rally. This could be a major bottom in Bitcoin and the Bitcoin stocks. Now, what else? Bonds. Let's talk about bonds and stocks and sentiment. So one thing I really try to focus in on is market sentiment. Remember the Templeton thing, buy at the point of maximum pessimism, sell at the point of maximum optimism. So I've been doing the Belkin report for 30 years now, long time. I left Solomon at the end of 1991 and started the Belkin report in 1992. And over the years, I've seen my clients who were, the hedge fund mafia at the beginning, Steinhardt and Tiger and all those kind of people. And over the years, I've seen sentiment swing drastically. I've seen investors kind of flock into trades, and trades get crowded, and then trades get ignored, things get ignored. And things can go along for a while when they're crowded, but generally crowded trades are looking for an excuse to reverse. So right now, if I look at sentiment, for instance, last year at the beginning of year, 2022, the AAII Individual Investor Survey had twice as many bulls as bears. So the ratio of bulls to bears was 1.2, more than 2 to 1. And then the market went down 33%. Get the picture? So individual investors were all bulled up at the beginning of last year. The NASDAQ went down 33%. Now, and by the way, and then all the Wall Street strategists, Morgan Stanley, all those, Goldman, they were sanguine on the market. They thought it would be okay last year and went down big. Okay, this year, all those Wall Street strategists, they're out every day, down 22%. Mike Wilson, about Morgan Stanley. They could be right later on. I'm not permanently bullish or bearish, but my model turned bullish on the stock market on October 17th, which was right after the low. So the S&P and the NASDAQ bottomed. NASDAQ bottomed October 14th. The S&P bottomed October 12th. And they're both up, moderately, nothing huge yet. But to me, that was a major trading low. And now we find sentiment is the bull bear ratio is 0.5. So right now there's 2 bears for every bull. So 0.5 means the bears outnumber the bulls 2-1. So it's the exact opposite of what it was last year. So last year everybody was kind of expecting the market to be okay. They've been let me just say, let me put a little fundamental perspective on this scenario. So why did we have a big rally? So COVID hit, the market crashed. They started a $9.5 trillion stimulus program in the US. That was $5 trillion of fiscal stimulus, $4.5 trillion of monetary stimulus, Fed balance sheet expansion, QE. That's enormous. That's 38% of GDP. And my model is very bullish from 2020 into 2021. So then they pulled the plug on stimulus, right? And everything went down last year. So, so where are we now? The Fed is saying they're going to keep raising interest rates. They keep putting out these people. They want tighter credit conditions because they think inflation is a problem. My model thinks inflation is not a problem. I mean, it was a problem, obviously, and my model had an upward forecast for CPI and PPI and all that in 2021 for sure. The CPI peaked in June, and the PPI too last year. So we're 6-7 months past the peak, and inflation is coming in. If you take the average inflation of the last 6 to 7 months in the CPI and PPI, it's right around 2% already. So they're looking at an annual rate of change, which is slow to change. So the Fed is fighting the last war. It's kind of like the French, putting up the Maginot Line to prevent the Germans from invading, and it lasted like 2 seconds. So, I think inflation is yesterday's story. Yeah, it's still there. It's kind of lingering, but it's declining. The price of energy is declined. I'm bearish on oil long term. I think it's going down. I think so what does that say? It's bullish for bonds. The fundamental story is the Fed doesn't know what it's talking about, basically. They're saying a bunch of garbage because they missed the inflation. Before inflation spiked, they were saying inflation is transitory. We're not even thinking about raising interest rates. Those are direct quotes from them back in 2020, 2021. So they were completely dead wrong. Now, after they've raised rates by 350 basis points or something, right? And they probably will raise another 25 basis points or something. But I think the Fed is going to find itself on the wrong side of history again very, very soon, and the economy is weakening, right? Which is typically bad for the stock market, but not yet. So I'm bullish. I'm still I'm long. I've been long for a while, getting my conviction tested last few days. Obviously, this week the market's down, but I think we're definitely headed into a period of where interest rates decline. So that's buy TLT. These are my recommendations to my clients. TLT is a T-bond ETF. Buy it on pullbacks. I think it's headed higher, 3 to 6 month as well as 12-month view. Okay. Stocks are a hold. They're not a buy right here. GDX is a buy. SLV, that's silver, is a buy. China FXI is a buy, and Bitcoin is a buy. So that's pretty much it. That's what I'm seeing. Those are the strongest signals from the model forecast. Now things change. I'm not a broken clock, and that's why people subscribe to the Belkin report. It's for institutional investors because it looks for these inflection points in things. So I'm on the lookout for a top in the stock market, but I don't think this is it yet. We'll see about that. One other thing, I focus a lot on sector rotation. So big portfolio managers use the Belkin report to decide, do they overweight or underweight tech, energy, consumer staples, consumer discretionary, et cetera. So the model is really good on that kind of stuff. It shows the propensity of sector rotation to go into an extended move one way or the other. And that's how you gain alpha as a portfolio manager. If you overweight energy, which was a favorite long of me of the model for the last year or two, not recently, then you could have big positive alpha. And so right now, the model likes tech. Okay, tech. It likes FANG stocks for outperform, which are in the gutter, by the way. So this is these are fresh signals. And some software stocks, you have to subscribe to the Belkin report to get all the list of names. The Belkin report breaks out groups and individual stocks within the groups for long and short ideas. So right now, for instance, Tesla and Amazon, those are two stocks that are in the gutter. Those are John Templeton, buy at the point of maximum pessimism. Tesla, everybody hates, big short position. Amazon has been a bad performer. It's gone down. So I see it's an inflection point in Tesla and Amazon for a trade. And that could lead FANG higher. So if the market continues to sort of, I think sentiment is looking for, I think sentiment is way too bearish. As I said, the individual investor survey, twice as many bears as bulls this year. Wall Street, the guys who said the market was going to go up last year, now are saying down 25%. They're all over CNBC and everything all the time. So I think that's probably a contrary indicator. Again, I'm not a perma bull by any stretch of the imagination, but I think the bearishness needs to get wrung out of the market. And I actually think that the stocks that people hate the most because they went down last year could go up a fair amount now. So going back into FANG stocks, which were the model was bearish on last year. They were my short recommendation. Now they're my long recommendation. So that's an example of how the Belkin report changes. So Tesla and Amazon for a trade long, leading FANG higher. The market kind of, I think this will be, let me conclude. That's pretty much the overall macro view. If I put on my thinking cap and think about what could happen this year in the market, I think it will be a lot of zigs and zags. So I don't think this is a buy and hold environment, even though I'm bullish, and I've been long since October. How long is that? November, December, January, 3 months now. That's worked, not massively, but I think there will be a series of these moves in sort of lightning bolt pattern. Good trading environment where you want to be long for a while and then short for a while, but not. I don't think. I think shorts. People are too short at the moment. A lot of these stocks with high short interest could rally. By the way, they're short Bitcoin stocks. There's big high short interest in a lot of the Bitcoin related names. So shorts could get squeezed for a while. I'm not into the game of squeezing shorts. I'm just looking impartially at what should happen in the market, how things are set up, how sentiment is set up. So for now, kind of a squeeze higher. People need to get squeezed back into the market, squeezed back into FANG, squeezed back into tech, and that could take a few months maybe. And then, before the next decline. So it's more like if I could conclude, when they hired me at Salomon Brothers, Laszlo Barini, he was head of market analysis. He's the one that hired me. I ended up in proprietary trading. I was the quantitative strategist. There were only 3 or 4 of us running the house account on the equity side. But anyways, when Laszlo hired me, I remember not long, that was the summer, back in the mid 80s, late 80s. He took us into the conference room, all the people that all his associates and that he'd hired. And he told us the story about trading sardines, which everybody should know. It's an old Wall Street story. A guy, the fisherman comes in from the boat has a box of sardines. The buyer comes down and the fisherman says, "These are the best sardines you've ever seen. You won't believe how good they are. I'll sell them to you for $10 a box." So the guy buys them for $10 and he takes the store and he sells them to another guy for $11, and that guy sells them to another guy for $12. And that guy sells them for, keeps saying the same story. "Great sardines, what do you taste them? Oh, so great, 15, 20. So the sardines go to like $40 a box, right? From $10. And then the last guy buys them for 40 and says, "These sardines are rotten. Why did you sell them to me?" And so that was the story Laszlo Barini told me. And the lesson I got from that, like people take different lessons from that, is, but you got to trade them. So they're, the guy, he goes back to the guy on the boat, and the guy on the boat says, he says, "These are rotten. Why did you sell them? What's the story here?" And the guy says, "Those aren't eating sardines. They're trading sardines." So that was the moral of the story. That's kind of a Solomon Brothers, trading, seat of the pants trading story. So you got to trade them, and then you don't want to get left holding the bag at the end of the story. So value investors say, "Ah, ha, ha, you shouldn't have bought them." But meanwhile, they went from $10 to $40. And so people traded them along the way. So my point is, I think this is the trading sardines market. So for now, I'm long the market, I'm long Tesla, I'm long Amazon, I'm long FANG, I'm long Bitcoin, I'm long Bitcoin stocks, I'm long GDX. And that could change, of course, over the course of the year. But so I think, you want to be able to catch some of these major swings up and down in the market this year. And so far, this has been a good swing up from October. Let's see how long it lasts. I think, again, to reiterate, GDX, TLT, FXI, Bitcoin, BTC, China, things like that are trades for now. And, as the year evolves, things will change, but those are my best recommendations for right now.
Thank you. This was great presentation. Now, I want to ask you about two sectors that have shown very good relative strength lately, which are the industrial sector and the financial sector. So if we look at the Dow Jones, it's actually sitting not that far away from all-time highs, and the financial sector has rebounded greatly. Is your model telling you something about it late now, or does it agree with this relative strength?
Hang on, let me get the sectors. So my work process is, the market closes on Friday. I dive in, I apply the model, systematically to everything: sectors, groups, stock indexes, everything one after the other. So, and I end up with individual stocks relative to the groups. And it's very time consuming. I work really long. I still work investment banking hours, Friday through Monday, applying everything. And it gives me a good view. It's like somebody looked at your car for 10 or 12 hours, they give you what was going wrong, what was good, and what was wrong. But so to answer your question, no, I think industrials is a tired trade. I had industrials as a long. I still have a few industrial groups, but no. Again, remember direction, position, intensity, position really late on all that stuff. Industrials, no. And you said financials. Financials also, same kind of a thing. No, the model does not like financials or industrials. It doesn't have a strong opinion on him either way right now. So I say neutral, but it's kind of a stale signal. What are fresh signals? So I remember energy down. Everybody likes energy down now, like a lot of my clients, "Oh, energy stocks, they're so cheap." Guys that just look at valuation. So, but the model does not like energy stocks, which is a big change. For 18 months or something, it was a favorite long. So I think they're kind of overowned. And I think even though China's opening up, I don't think it's going to be a huge source of demand for crude oil. They're buying oil on the cheap from Russia. India and China are buying discounted crude, $20 below the list price, of West Texas. So anyways, energy doesn't like, and to answer I'm kind of digressing from your question, but things that have just changed in sectors are healthcare and consumer staples, negative. Okay, so that's a sort of a positive sign for the market. So healthcare and consumer staples. They're defensive sectors that usually outperform when the market goes down. Okay, when healthcare and consumer staples are negative, when they underperform, that tends to support the idea that the market wants to go higher. So right now, the strongest signals I have are defensive sectors underperform. That's healthcare, staples, and energy. And I have tech and consumer discretionary wanting to outperform. And those are more alpha, those are like beta, those stocks means the market wants to go up. The only defensive sector that I have as an outperform sector right now is REITs, real estate, and they're kind of really depressed. So from sector-wise, tech, consumer discretionary, and REITs, and communication services. That's also Facebook. It's called Meta now, META. Those stocks really got knocked hard last year. So those stocks look like they want to bounce. Tech, that's FANG. Consumer discretionary, that's Tesla, things like that. And REITs, that's defensive, but it's in a different cycle than staples and healthcare. And then communication services, that's more Meta, Google, things like that. So the sector rotation is really pretty positive implication for the market at the moment. And that's certainly not what Wall Street is saying. That's they're not telling you to buy tech, Wall Street, investment banks. They're not telling you to buy consumer discretionary. They're not telling you to buy communication services for the most part, and they're probably not telling you to buy REITs. So it's as far as industrials and financials go, kind of neutral, no strong signal at the moment, but it's actually sort of a bullish sector rotation forecast in terms of implications for the stock market.
Thank you. And now, as a last question, do you have any views on the dollar? Because recently has been coming down pretty hard after a major rally last year. So I just wanted to know if you have any view, or does your model have any strong opinion about the dollar?
Yes, good question. Major dollar top long term. So 12-month view. I should have mentioned that those were my earlier, strong model signals, dollar down. And that dovetails into gold, precious metals up, gold, silver up, and gold stocks up. And it fits with the scenario of the Fed is going to be proven wrong and be forced to retreat and stop raising interest rates and ultimately cut rates. Certainly not at the next meeting, but sometime, over the next 3, 6, 9 months. And by the way, that could turn into a big rally in Eurodollar futures. If anybody trades those things, those are really despised. If you look at now June and September contracts, they're really in the dumps. And if the economy starts coming in weaker, that's bad for the dollar, good for Eurodollar, which goes up when interest rates go down, Eurodollar futures, ED. It's good for bonds, potentially TLT. And it kind of fits in with the idea of maybe, Europe is sort of behind the US on raising interest rates. The US has already raised, Fed's already raised interest rates by 300-400 basis points. Europe is hardly anything. So even though, so there might be this catch-up thing where Europe keeps raising interest rates while the Fed stops and begins to cut. And ultimately, I think the economy is going to come in much weaker. Now, this is kind of a dangerous scenario because I'm saying to buy stocks into signs of economic weakness. So that usually doesn't work, although sometimes you will find if you look at history, stocks can rally when earnings decline for a while. But it is a dangerous, if I didn't have the model telling me to do this, it would sound kind of foolhardy to say this. But I think the psychology, the mentality of the market, you mentioned the dollar going down, that would be a sign of economic weakness. So I think all these people that think only of what the Fed does is the only thing that matters to the market, they have to get hooked. So the psychology has to go from, oh my God, the Fed's raising interest rates, like they put out these people, the Mary Daly from the San Francisco Fed, and all these people are coming out, oh, we're going to raise interest, we're going to raise. They aren't even voting members. They're just putting these people, they're trying to affect, the Fed is like making this psychological, they're just trying to psych people out, right? But but if the economy like we're seeing retail sales coming in weak, industrial production, everything's coming in weaker, right? PPI, all the numbers are coming in weaker. I think that's a sign of things to come. So I think the psychology has to go from, oh God, the Fed's going to raise interest rates. It's bad for the stock market. To, oh God, oh boy, the Fed's going to stop raising interest rates. They're going to start cutting interest rates. Oh, let's buy stocks. So I think that we have to go into that psychological transition where people get comfortable again and bullish again, and people that only care about what the Fed does. And that drives the market up psychologically for a little while until not forever. Don't get me wrong. I'm not a bubble person, but I think the psychology has to change. Shorts have to get squeezed. Wall Street has to get proved wrong. The bullish consensus has to go from half 50% bulls to 150% bulls. That would be the sign of a market top to me. So that's a sign that's consistent with everything. You asked about the dollar down on signs of economic weakness. Stock market could rally for a little while on that, on the perception of a change in Fed policy, but ultimately it's not going to be great for earnings. So I think like I said, this could be a trading sardines market year, and I will at some point I will change and be short again on the stock market. I don't see that right now. It could come up later this year.
Great. So thank you so much for your insights. I think a lot of people, as you said, are too bearish right now and they are getting squeezed. I mean, not in the last days, but they could get squeezed, especially if the Fed changes the approach in the next meetings. So as we wrap up, where should people go to learn more about the Belkin report? And if people want to be able to access it, who should they contact? Where should they go?
Marc Mishkin handles everything for me for the Belkin report. Maybe you can put up his contact info. So Marc Mishkin, Hyperpyron Partners is the contact for that. And perhaps you could put the contact info up. That would be the best way to get in touch with the Belkin report.
Great. I'll put all the details below. So Michael, thank you again for being here and for taking the time.
Thank you so much.